The rupee is not having a good year at all. Last week, it hit the lowest it has ever been so far, reaching almost 89 rupees to $1. And the worst part, there is no assurance that it will not lose value further. The detractors of this government are already warning that we are heading towards a century. 100 rupees to $1. Be as it may or may not, there is no escaping the truth that the trend has been on the low and low throughout this year. The nation's GDP may be growing to whatever $1 trillion and making it fourth or fifth or third, the largest economy and whatnot. But when it comes to the nitty-gritty, the exchange value has been on the down and out. In fact, in 2025, the rupee has lost 3% of its value till now. Actually, it's 5%, nearly 5% when you take just the last 5 months between May and this month. That is actually less than the total drop in value of the rupee between December 2022 and December 2024, 2 full years. But come 2025, the Indian rupee has been in free fall. This year has been particularly bad because of the entire tariff trauma induced by the US president. His 25% tariff blow, coupled with another 25% penalty, not to forget the cracking down on H-1B visas and the proposed 100% tariff on branded pharma, they've all together hammered away at the value of the notes in our pocket. But you know what? We can continue to blame Trump and his tariff, and increasingly so in the coming months when the full extent of his tariffs will hit, that could make the currency's performance even acute. But is that the only reason? After a couple of years, especially post-COVID, when the Indian market's stellar performance was a beacon for the rest of the pandemic-hit world, it seems like India as a destination for international investment is cooling off. Foreign portfolio investors have been on a selling spree of the Indian assets in the past few months. Not to forget that the higher trade deficit the country has is increasing the demand for dollars compared to the rupee. Of course, the fall in value whereby the rupee dropped from 85 rupees in the new year to 88.7 today may not be much compared to some other currencies. Like for example, the Russian ruble, which has actually lost 35% in value just this year and another 34% last year. But for India, it's a big deal when you add in all the other factors. Trade is getting way more impacted once the US tariffs and H-1B visa restrictions start to bite. And there are thousands of jobs in areas ranging from textiles to IT-enabled services that are on the line here. While domestic manufacturing, where a boost is always dependent on export, which will get royally pinched unless that crucial US trade deal is somehow signed. Until then, this scenario will be pretty worrisome. And not just because the rupee is weakening, but the fact that it could exacerbate inflation or price rise in the country. There's a lot hinging on the GST and income tax rate cuts, and that is to catalyze domestic spending, which can boost the economy because due to a lack of export uptake, now if prices rise drastically, it could well kill this Brahmastra of GST Bachat festival before you know it. So what's the way out? Like I just said, a boost in domestic consumption due to all the GST reforms is the best antidote. But how effective it will sustain itself in the long run, especially if the tariff troubles deepen, is anybody's guess. The Reserve Bank could also intervene more. It had recently scaled back interventions, but it could help to boost the rupee through a series of measures, including a possible repo rate cut. And also, if all those NRIs sitting abroad and sending WhatsApp and Facebook messages saying how great India is, If they can just put their money where their mouth is by sending more remittances as well as even investing in the home country, maybe, just maybe, it could really help.